Hey everybody, welcome to Trading Capital's exclusive analysis of the markets. Today is currently March 13th and we have lots to discuss. In today's video, we're going to be discussing the S&P 500, doing a little bit of technical analysis, some of the price action I think you need to be aware of. We're also going to be touching base on the long and short duration treasuries, specifically the 2-year yield and the 30-year yield, and what the price action is implicating for the overall investment landscape. And then we're obviously going to be touching on the high flyer Bitcoin because that has just been in a world of its own, demolishing the stock market. As the stock market's heading lower, Bitcoin has been flying. And then we're going to be discussing fear, the powerful emotion, the reading that we're getting on the VIX and gold, and why that's important to the overall sentiment and moving forward. And then, of course, we'll touch base on the overall energy complex, natural gas and oil, and what is transpiring in those specific sectors. And then we'll also be touching base on some of the trades that we executed and closed for a profit today, and just overall giving back to some of the members here because we have had a stellar year so far and we continue to believe in good karma and producing a lot of educational content. Now, starting off with the S&P 500. Overall, we can see that it was a down day on the S&P 500. You did finish down by just 0.14%. Now, at first glance, when you consider that the S&P was only down slightly negative by 0.14%, and you've had massive banks like Bank of America, Citigroup, Wells Fargo, then you go to the regionals, FRC, WAL, all getting decimated. I mean, FRC was down 61% on the daily close, and it could have more downside. It's just scary how fast these banks are dropping, but one of the reasons why the markets have not had a more of a downside move than what should be expected with banks blowing up and all this contagion risk in the system is simply because tech has been holding up so well. And when you factor in that technology has the heaviest weighting across all of the indices, that's why this market hasn't seen a precipitous fall. But if tech starts to give up those gains, watch out below. Now, looking at the S&P 500, you can clearly see that the last 3 days, this was Thursday's daily candle, Friday's daily candle, and today's daily candle. Now, at one point, the S&P was going positive and it was trying to recapture. But why did we get rejected off of this white trend line? Well, if you simply zoom out, look at this beautiful price action. Connecting a multi-pivot trend line. This trend line was your original resistance over here. Then it was your support when you came down and bounced. And now it's going to be resistance. So now that we have a clear resistance level on the S&P 500, as traders and investors, you know what level to trade against. If the S&P can capture that area, it will likely try to go and attack the next pivot high around this 405 level. But this is a massive level for the S&P to try to get through. Now, in terms of the negative price actions, obviously you can see that we've had a 3-bar surge below the daily 200. Typically, when you're below the daily 200, bad things typically continue to transpire, which is why I'm still remaining bearish. I do think there is more downside in the S&P 500 in the near term and over the longer term picture. But nonetheless, the markets are getting a little bit of short-term oversold conditions here, and you are into a little bit of consolidation support. But just because something is oversold doesn't mean it's guaranteed to get a technical bounce. Tomorrow, we have a huge data point at 8:30, the CPI. And the CPI narrative and expectations have kind of been muted as of late just due to the overall banking crisis and blow up of a couple different banks. But in terms of CPI expectations, let's touch base on yields to give us some further insight as to what the bond market is expecting and more importantly, what the Fed is likely going to do. So first off, I'm going to be drawing this trend line, basically carrying it forward. This is the 2-year yield, so the short duration treasury. The short duration treasury in the last 3 days has fallen precipitously from over 5% down to about 400%. You can clearly see you hit the daily 200, which is why this has been a stopping point for the treasury yield. Now, with this 2-year yield falling this sharply, this precipitously and quickly in 3 sessions is not healthy. Tech in the short term has taken this as a healthy aspect to rally in the near term as cost of capital is now becoming cheaper. But let me be clear, when this falls at a magnitude as it is not a good thing, especially when you factor in inflation expectations are around the 6.1%, showing that yields are still deeply negative, and when you're losing additional 2% return on your bonds, it's not a good thing. Definitely not a good thing. Now, touching base on this yield, can we get a short-term bounce? Yes, it's absolutely likely to get a short-term bounce considering you have hit support, but inflation can change things drastically. We have a couple expectations as to what the market is thinking for rate hike expectations. The mainstream news is expecting 0.5% still. The bond market as of today is pricing in a minus 0.5% cut, so a 50 basis point cut. Here at Trading Capital, we think the Fed is just going to hold. The current Fed fund rate is at 4.5, so it's putting you right up around here, this wick high on the candle. I think the Fed is just going to maintain that, and I don't think they're going to raise at this point in time. However, that is all subject to change. What if inflation does come in hotter than expected? That would be the worst case scenario for the markets if inflation actually uptick. Because keep in mind, this deflationary collapse in the banks is not actually going to be reflected in this CPI reading. The CPI data that we're analyzing this month is actually from February's data. So it won't be until the April CPI reading where perhaps all of this deflationary scenario in the banking sector starts to reflect. So could we get maybe one more pop in CPI or a slightly hotter expected number than what the market is expecting? If we do, this market likely sells because these short duration yields will likely continue to rise. Now, the interesting thing about the long duration treasuries, and this is why it's so important to understand how liquidity flows in and out of the markets. And that's what we try to do here, is keep our members abreast of where liquidity is flowing, because that's all it is. A stock doesn't represent how good a company is or how bad a company is. It simply represents liquidity and the flow of money. Now, what I'm looking at on the long duration treasuries, the 30-year here, is you had a massive move down intraday, and look at that bounce. You hit your technical support, and you had an epic daily reversal candle, putting in a daily reversal, and this is bullish price action once again on the US 30-year yield. Now, what this means is that we're actually seeing a possible scenario where credit spreads are blowing out. And when credit spreads blow out, that is the worst environment to own stocks, specifically risk assets. And I do think that there's signals in the market where people are moving a little bit more defensively. But typically this long duration spread, now that the 2-year yield is collapsing and the long durations are rising, it is narrowing that yield curve inversion. As soon as that yield curve inversion starts to come back to the positive side, that is when stocks and equities see their worst decline. And that is what we're potentially entering here. Now, there are going to be some specific trades that my members will be privy to. Basically, there's been some high opportunity, high conviction trades based off of the short durations rallying extensively. Now that the short durations are coming down sharply, and we're looking like to be that the long durations are going to see more upside, that's going to provide a little bit of a different opportunity in some of the sectors to potentially go long and short. So there's definitely a difference in when short duration are rallying and long duration are rallying. And there's a big difference in terms of how capital flows in and out of the stock market. Now, let's look at Bitcoin. Bitcoin right now has had a massive move to the upside. If we simply look at this chart, let me just erase all of these trend lines just to clear it up. But Bitcoin has had an epic move. This was the level that hit Bitcoin's first resistance was at, and it blew through that level with no problems at all. Now, the next resistance for Bitcoin where I think it's going to hit is this major pivot to this major pivot zone. It puts you at around a pierce of 26,000. That's where I think the upside move and the completed move happens in Bitcoin before it starts to roll over. Let me be clear, Bitcoin is not going to be immune from what comes next in the stock market. If we're going through a banking crisis, Bitcoin is not going to be immune. So I do think that there's going to be downside, but there's likely going to be one more surge to the upside before Bitcoin becomes that high conviction short and before the crypto stocks really start to roll over and take a beating. I love crypto long term. I do think that there are key levels that you can start to accumulate long term. Certainly some people started buying and accumulating down here, but believe it or not, my expectation is that how cycles work and knowing how cycles play out in the stock market, it's pointing, cycle analysis is pointing to Bitcoin having a final capitulation dump out before the bigger move to the upside commences. Now let's touch base on fear. the most powerful emotion, starting with the VIX. The VIX has had a massive move off the lows. This was one of our epic trades today via the UVXY. We actually had an entry around 511 and we sold at $7, so we netted a beautiful 34% gain. But the VIX is signaling increased volatility, and believe it or not, now that you've had a secondary daily close above the 200, this points to the fact that you could see the VIX up to about 35 on the charts, and that would certainly be a negative headwind for stocks. And one of the reasons why we know there's fear in the market, take a look at gold. Let me just remove all of these trend lines here. Look at this 3-bar surge in gold. You've basically trying to recapture this overall uptrend and this consolidation pattern, but now gold is into some key resistance. I think we've seen a flow of money into gold. It's getting short-term overbought, but fear has a tendency to overshoot prices to the upside, and it also has a tendency to overshoot prices to the downside. But with gold rallying this sharply, it doesn't mean it's immune to pullbacks. One of the reasons gold is the safe haven asset in this fear time is because it has no counterparty risk. And what is the issue we're going on right now in the banking sector? Counterparty risk. Depositors are fearing that they're not going to have access to their money if a bank goes under. So that's what it means, counterparty risk. Gold has no counterparty risk. Gold is gold. And basically it's tangible. But gold could see more downside in the event of margin calls and a true liquidity crisis. Because if people start getting margin calls, which I actually think there may be margin calls coming in the near term, specifically with some of the major banks as they have declined, we could see gold take a hit in the near term. But nonetheless, it has been an absolute powerhouse in the last few sessions, and it's certainly something to be proud of if you're a gold bug and holding some gold miners and gold longs at this point in time. Now let's touch base on energy, because energy is signaling many things to us. Obviously, let's start off with the beloved natural gas. Believe it or not, we're still waiting on natural gas to go long. Natural gas has hit our first technical support level. I did not personally get in, although we did miss this beautiful 7% move. I still think natural gas has a potential to, believe it or not, go a little bit low on the charts. Now let me just remove all of these drawings to show you what I'm talking about. I do believe natural gas is put in the near term low, and this is a definite powerful cycle low, a likely cycle low, but it doesn't mean we can't retrace a little bit more. And keep in mind, this week has a whole host of data, economic data, but also what happens on Friday? Options expiration. It's a quad 4 witching, so it's a quarterly expiration. Now, why I think natural gas can go slightly a little bit lower is simply if you look at this trend line, connecting your major pivot. This was where you attempted a reversal, failed on the gap down and made new lows. And this is basically your breakout line. I think natural gas could retrace a little bit lower to about 233. However, it's not a guarantee. We could be potentially off to make new highs in natural gas. And based off of pattern, we will still be able to get in and execute some buy orders either via UNG or Boyle. And I still think natural gas has a tremendous amount of upside, even if there is a little bit of near-term weakness. I'm just a stickler for price on this specific asset because I've seen the way it moves. A 7% move is really nothing in natural gas. You could be down 10% tomorrow. You could be up another 7%. This asset is wild, and we just have to be mindful that it is options expiration on Friday. Now let's touch base on oil. US oil is the ticker that we're looking at. Oil is looking exceptionally weak. Let me just erase some of these key trend lines over here. What I'm watching for oil is a potential breakdown. So basically, if we extend this trend line across, you can clearly see from your pivot high all the way down to here, oil is on a near-term technical failure of a breakdown. So basically, oil was defended. You can see it pierced this level with clear conviction, but the oil makers and oil price action was able to save oil, and it lives to fight another day. Oil is looking very susceptible, and the crazy thing about oil selling off this sharply is it hasn't been on a strong dollar. Oil's real catalyst, basically from the high over here to the low, has been on a strong dollar. Now that the dollar has subsided, why is oil falling? Could it be a deflationary demand destruction occurring? Could we be maybe just expecting another release from the Biden by saying they're going to increase? I think their last release was roughly 23 million barrels from the SPR. Could they be coming out with another announcement in the near term? But when oil starts to diverge from the main catalyst that took it down from the high to the low, which was a strong dollar, and now the dollar is weakening and oil can't even get its butt up, that is a negative price signal in terms of what I'm observing, which is why we are short some of the energy stocks in the XLE. Now, in the near term, I still am a huge oil bull. I support the thesis of oil going much higher. I do think in a couple of years, oil will be over $100 a barrel, pushing maybe even 200, just depending on how bad we let inflation get out of the bottle. But in the near term, I'm still thinking oil has to fulfill the $66 level, and really that's going to be your next big technical level. But this is technically starting to form bearish consolidation, and you're on the near precipice of breaking down. So we just have to be mindful that oil is in everything in our economy. It is a great signal for the overall economic health, and if oil starts to decline and break key levels, that is a little bit of a leading indicator that the economy is starting to wane and break down. And it's going to be interesting to see if the Fed puts us in a scenario where they do over tighten. That's kind of the near term issue that I could see arising, is the Fed over tightening. Now, let's take a look at some of our trades that we have completed this year. So this is a little bit of a back end that some of our members have seen, but basically when I share this tab, you can see that today, the March the 13th, we closed an exceptional amount of 1, 2, 3, 4, 5 winners. And this last month has been the most profitable month in my investing career, my 10-year career. And I'm very proud of that because this is a new trading capital service that we launched last year in hopes to protect the average retail trader and maybe some institutional players from the horrific cycle that is potentially at play. And if you've been following our trades in 2021, you would have smashed and beat the market by a great margin. And if you've been following our trades this year, you would be smashing the market. We are up over 28% year to date this year. All trades are verifiable through our alerts. All trades are tracked through our website, and we have just been crushing it. I mean, simply today's market session alone, we banked 14% here, 18% on Tesla, 34.5% on UVXY, covered our cat short, covered half our Hyatt short. So we have been banking winners left, right, and center, and it has been a stellar market. So we kind of want to just keep our good karma going, give back to any retail trader that is not understanding where this cycle is likely going to head. And I do think that there is more downside in this market. However, things don't go down in a straight line. And that's why it's been such a difficult market to trade. It takes a lot of work behind the scenes in the after hours to do the analysis, find the trade setups, execute the trade setups. Knowing is not enough. It's how you implement and actually put that knowledge to work, which is going to make you successful. But to sum things up, I just want to say thank you to all my members for supporting us through the 2021, 2022, 2023 process. It has been phenomenal, a great learning experience. Every day we get to learn something new in the market. And if we can profit while we're learning, that is just the ultimate career and the ultimate way to set up our retirement for success. On that note, I'm going to please encourage you to share this channel, like this video down below, and please, if you have any questions, any way that Trading Capital can help you facilitate a faster retirement or help you facilitate preservation of wealth and capital, please check out our website and don't hesitate to ask us any questions at all. On that note, take care everybody, and we'll see you on the charts later.